So I'm here today really to, I think, take up the challenge of dealing with the kind of change that we've experienced in the United States and that we're seeing perhaps about to unfold here in Australia and elsewhere around the world, which we do view as a different paradigm from the way that, that perhaps many of us were trained to think. And in thinking about paradigms, how they evolve and why they change, it's often useful to first of all look at how we got to where we are before we start thinking about where we might go from here. So let's look at how did the very notion of retirement get started. Because when you think about it, it's a relatively recent idea. As you can see from the data on this chart, in the 1800s, the average European had a life expectancy of somewhere between 30 and 40 years, depending on just how nasty the wars were during the time that they were alive. And the concept of retirement was the word literally didn't exist in any European language in the 19th century. You simply worked until you died. What changed that was a bold step by that notable social reformer, Count Otto von Bismarck, who, for a bunch of domestic political reasons, this is probably starting to sound familiar, thought that he could maybe raise taxes if he offered what would surely be a populist idea, which is a universal social security system for Prussia, now Germany. But he was a very shrewd man, and he decided to set the retirement age at 70. At the time, the average life expectancy in Prussia was 45. Now, Bismarck's system was eminently sustainable, but perhaps not all that effective for the members in the plan. However, oddly enough, it proved to be exceedingly popular, despite that. And I think what unfolded over the next half century is a testimony to just how much appeal there is for some kind of certainty, some kind of ability to plan one's retirement. What happened is countries around the world began to emulate Germany, began to enact Social Security in various forms. This really accelerated during the Great Depression. And in fact, they liked it so much they started to reduce the retirement age to 65 in many countries, even lower in others. Meanwhile, the life expectancy of the average person in almost every country in the world started rising very quickly with the transition first to the industrial economy and then to the service economy and the introduction of better public health and so on, which meant that by about 1950, for the very first time in human history, those two lines on the chart, the life expectancy and the retirement age, had crossed. Think about how recent a concept this is. This means that really our parents' generation was the first generation in human history who had a realistic expectation of enjoying some kind of funded retirement, which is a pretty recent development if you think about it. And from their perspective, this was very, very effective as a life planning tool. I think many people in this room, including me, are very happy that their parents have some kind of retirement benefit. On the other hand, the issue that lurked was one of sustainability in the system. And in fact, what we saw is over the last half of the 20th century, as life expectancy continued to extend, but retirement age stayed stuck at about 65, there became more and more reasons to doubt the sustainability of the system. And that brings us to the issue of how about us and how about our children? What's the world going to look like over the next 50 years? As life expectancy will probably continue to grow. We don't know exactly how fast. There are optimists, I'm not sure if they're optimists or pessimists, who think that heart disease and cancer can be vanquished, at which point we might be looking at the steeper dotted blue line on the chart. And others, again, I don't know if they're pessimists or optimists, who think, no, obesity is going to mean that we're going to finally see life expectancy shrink. That solves the problem completely. But I think the more reasonable expectation is that we will see life expectancy continue to rise. It's possible that the retirement age might tick up a little bit too, but as we've seen in many countries, including the US and Australia, it's politically not easy to make that happen, so it always gets phased in over long periods of time. And the result of this, I think, is that the gap between the two, the blue line and the red line on this chart, will continue to be very large. That's creating gigantic problems for defined benefit programs, obviously, and is one of the main reasons why defined contribution in a variety of different forms has been the successor scheme in virtually every country on earth. And just to dramatize this, I wanted to show the data for the US, because I think it'll look very reminiscent for those of you who've seen the equivalent numbers here in Australia. As of 1979, over 2/3 of all Americans had only a DB benefit, and the other third had at least part or all of their reliance on DC. So not that very long ago, DC was a very small part of the US retirement system. As of today, as you can see clearly from the chart, the percentages have exactly flipped. And now DC is the retirement pillar for over 2/3 of American workers, and actually within the next decade that will rise towards something like 80%. And this means we really, all of us, have a major burden. We have to figure out a way to make sure that DB doesn't end up the same way DC doesn't end up with the same fate that DB did. I think that there have been a couple of comments in earlier sessions about maintaining the confidence that members have in super in this country. And I think it's a very serious mandate, something that all of us should take into consideration, that there have been a couple of attempts to make retirement work. The Bismarck way was very sustainable but not effective. The DB idea was a beautiful idea. Frankly, I wish that it had been sustainable, but it proved, unfortunately, not to be. I think with DC, we have our last greatest chance to make this work. And I think it's incumbent on us to figure out how to do that. And it's a very daunting challenge, because DC as an investment problem is actually far more difficult to solve than DB. The benefit of DB is that you're pooling not only assets, but also risk across the lives of many, many different members. Whereas in a DC plan, each individual member has to worry about their own individual longevity risk and other risks that they face as an individual. You can't pool your personal risk of living a very, very long lifespan, which will be difficult to fund. And as you can see, the most recent data from the Australian government actuary on life expectancies in this country are pretty daunting. If you're one of a couple at age 65, there's a 50-50 chance that at least one of you will live to age 90, and there's a 25% chance that one of you will live to age 95. So that means that if you're retiring at age 65, and you want to have at least a 3/4 chance of success that you'll have enough money to fund your retirement as a couple, you have to think about this as a 3-decade problem. You're going to be spending money for 30 years after you retire. When people talk about whether 9% contributions are enough, I think they really need to keep that in consideration. And to me, this really is the problem that we have to help people solve, because it is so very difficult from a planning standpoint to do it, and we're putting the burden of this very difficult problem on the shoulders of individuals who don't see investment management as their primary career. They think they have a job already, even though they know that the investment managers, of course, all do drive those red Maseratis. Indeed, that really is the conundrum, because what we know for sure is that the do-it-yourself model of investment is not really what the majority of members, or as we call them in the United States, participants in DC plans, really want. When you ask them the question, do you feel you're really an active investor, that you are excited and interested in making choices between large and small and value and growth and domestic and international stocks, about 1/3 of investors, and we've been running these kinds of surveys for years and years, and the results have been very consistent. About 1/3 of investors say, yes, that's me. We think that's an exaggeration, because we think a lot of people believe that's the right answer. So the amazing thing is that about 2/3 of investors will tell you, no, not me. I'm not really very comfortable making these decisions. I see it as a burden. I actually lack confidence in my ability to succeed. How often do people say that? Well, one very interesting example of surveys where people give biased answers is if you ask people, are you an above average quality driver, something like 75 to 80% of people say yes. I could have done the experiment in this room, but trust me, nobody wants to be below average. But on this question, people uniquely actually have the self-awareness to recognize that they don't want to be chief investment officers. They're scared of this responsibility. They know it's important, and they know that they are not fully equipped to do it. Which means that the issue of engagement that I think is very much in people's minds right now, both here in Australia and in the US, is a critical one. And so I think that many of the questions or issues raised by the Cooper Review, whether you agree with where the review came out or not, are the right questions for us as an industry to be coming up with answers for. I think we do have to find a way to appeal to both the minority of DC plan investors who want to be controlling outcomes and making decisions, and the majority who don't. I think we have to find ways, whether we call it MySuper or something else, to make the process seamless and effective so that both the engaged and the less engaged investors can really get good outcomes without necessarily spending all their life focusing on it. And when I say all their life, I think that this whole of life focus is critical. Thus far, most DC plans have been overly concerned with the accumulation phase, and we need to make as an industry, to have a solution that really does encompass what the money's being saved for. And I think that as you take that perspective, it becomes very logical, as the Cooper Review suggested, to think about trustees trying to weigh, among other things, investment risk, inflation risk, and longevity risk. Now, in the United States, we have the benefit of having really messed up DC for many, many years. Because in our model, for many years, we had an excessive focus on individual choice, and everything was packaged in retail fund form. If people are interested, I can spend more time talking about why I think this happened and why, why it's an easy trap to fall into. What's interesting is that we did end up as an industry, and with some help, oddly enough, from our own government, which usually doesn't prove that helpful in our case either, we did have some help in, I think, escaping from that spiral. And the way it happened was that an option was created for DC plan sponsors to get fiduciary protection from having a default that could be one of a couple of varieties, but the most popular one was a target date type structure, which I think allows many of the issues that are raised in the Cooper Review to get addressed in a pretty seamless fashion. And I'm an optimist on this front. I don't think that MySuper necessarily will mean dumbing down investment structures inside DC plans at all. I think it's quite the opposite. It has the potential to allow far more sophisticated solutions for whole-of-life type investment. And I think it'll allow the integration of very sophisticated tools for managing investment risk, inflation risk, and longevity risk. Just very quickly, I hope everybody has heard of target date funds, but just for those of you who may not have, the idea is very simple. If you have a target date default fund, what that means is that for every participant in the fund, in the scheme, who doesn't make an explicit choice as to what to do with their money, or who does choose specifically to be in the target date scheme, you take their age of birth, so that, let's say you were born in 1960, for example, and add 65 years to that, 65 being the retirement date, and that would mean that you would be placed in a fund that would be called probably the 2025 fund, right? 1960 plus 65 is 2025, along with a whole cohort of other people whose birth dates were around the same time. And the reason that that's a very logical way to structure things is your cohort of people probably all have the same broad need for making their investment strategy move gradually away from risky assets like stocks that have high expected growth rates but also high risk, towards less risky assets like bonds that have lower risk but also lower return as you move from your younger saving status when you start work towards retirement and then through retirement. So you can imagine that that's a very logical structure, I would think, for any investor as they're thinking about their lifetime asset allocation. And we think it's especially appropriate in a DC plan where by definition, if you know one thing about every single member, it's when they were born. What we found in the United States is that there's been a rapid adoption of this kind of target date structure as the default. I should have put on the slide that in 2003, less than 5% of all US DC plans had target date default funds as their default option. By 2006, which is before the law had actually come into effect, the law called the Pension Protection Act came into effect the following year, already a third of plans had actually already moved to target date defaults in anticipation. So I think that's actually an interesting point. You don't have to wait for government to tell you what to do. You can actually begin to move in that direction preemptively. As of 2009, it was up to 69%. As of this year, it's going to be in excess of 75%. My guess is that in the very near future, the quasi-totality of all US DC plans will have a target date default. I think this is one of the fastest structural changes in the investment industry that I've ever witnessed in my career. And I think it's because both plan sponsors and participants really understand and agree that this is better than what they had before. And despite everything that happened in the market crisis in 2008, we've done many surveys, those results have stayed rock steady. Participants like target date funds, and so do plans. And we think the dynamics of this in the industry are going to be pretty dramatic. Because target date funds are now the default investment, and so money is getting defaulted into them, the same thing is going to happen over time that you've already seen happen here in Australia, which is the default funds are where the majority of the assets will end up. We think that over the next decade, basically all the growth in the DC industry in the United States will be in the assets of target date funds, which means that 10 years hence, as you can see on the chart, the target date business, if you think of it that way, by itself will be bigger than the entire DC industry in the United States is today. And the US DC industry, depending on exactly how you measure it, is roughly 4 times the size of Australia's. So we think target date investing is going to be the single most important decision that a typical plan sponsor in the United States ever makes. How do you choose what default you have, and if it's a target date fund, what does that target date fund look like? We also think how you implement that choice is going to be a really critical question. So what we're finding is, interestingly, many plan sponsors are saying, well, if it's so great to have a default option that's better, like a target date fund, does it matter how I do that? And the answer is it matters a lot. If you just add a new option to your investment menu, typically what you find is a tiny proportion of people will allocate to it. So typically somewhere between 2 and 4% of assets in the plan will move to something that's just added to the menu. On the other hand, you can also, in the United States anyway, have what's called an investment re-election, which basically means, okay, we have a major structural change in the plan. Everyone essentially will be defaulted in as of today unless they explicitly opt out. And when you do that, typically 50 to 80% of the assets in the plan move into the target date fund. And that's actually what happened with our own DC plan in the United States. So just over 50% of the assets, we did a re-election, and just over 50% of the assets in our own plan ended up in target date, despite the fact that there's an awful lot of professional investors at AllianceBernstein. And then there's a third option called an investment reset, which is an interesting choice. Basically, it involves moving all the assets in the plan into the target date default, and then allowing people to move out if they choose. Obviously, because people tend to have a bit of investment inertia, that means an even higher percentage stay in the default. So there's lots of interesting options and ideas that are, I think, possible in the United States. One thing that I would say is that there's also some big mistakes that were made in the initial round of transition to target date funds in the US. What we have found is that a lot of people are now thinking about customizing their target date portfolios, and you might say, well, what does that mean? Well, when first target date funds became available in the US, they were almost all retail mutual funds. And by the way, AllianceBernstein is a good example. We launched our retail target date mutual funds some time ago. And in that structure, whether it's AllianceBernstein or another provider, an off-the-shelf target date mutual fund will be essentially owned by a fund company. which determines the asset allocation and all of the components. And guess what? Typically, if, say, AllianceBernstein is running the mutual fund, who do you think is probably managing all the sleeves? Well, guess what? It is AllianceBernstein, no surprise. And that, I think, is a very sensible type of vehicle for certain smaller plans, but it makes little sense for the kind of very large industry funds that are predominantly in this room today, either here in Australia or in the United States. If you have billions of dollars in assets, it seems to me it's a bit strange to be really allocating all of that to any one investor. And both from a fiduciary standpoint and from an effectiveness standpoint, you really should be looking for best-in-class managers the same way you do today in your super funds, and you should be thinking about getting the best advice about asset allocation and, frankly, everything else the same way you do today in super funds. The good news is that's very easy to accomplish, and we have also got, in fact, the majority of the target date assets that our firm manages are, in fact, in open architecture type structures, which are customized to the needs of an individual fund. And this is why I think that the idea that my super would be a race to the bottom is exactly backwards. Because no two super funds and no two USDC plans are really quite the same. Every single fund is going to have a slightly different type of membership, and that membership will change over time, too. If you have a particular membership, for example, if you have a lot of retail employees who are in their 30s and probably have a term in the job of, on average, 3 to 5 years, they probably have a somewhat different investment and savings profile than a firm or a super fund that caters to a lot of engineers that probably are going to spend 25 or 30 years in the job and will have much higher salary levels and much more persistency. There's a number of other issues, of course, that matter too. The income replacement goals that a plan might want to set could be different for different types of fund. And indeed, you could also think that in some cases, there will still be legacy defined benefit plans that are held by some significant fraction of the members of some DC schemes and not others. That too could have an effect on what is the appropriate type of asset allocation to choose. So for all these reasons, what we found as we've customized target date funds for many of our clients is that you get a range of sensible glide paths. The lines on this chart show how the equity allocation shifts as an individual member moves through the life cycle. And at age 65, you can see that on our standard glide path for a typical American DC plan, we would typically have about 55% in equity-like risk. But there are some plans where it makes sense to have quite a bit more than that, as much as 64% in one particular plan's case, because they also have, in that plan, they also have a very strong DB benefit, and therefore the DC plan is more like a supplementary benefit for them. There's another plan that we advise where the benefit is actually, where it's the opposite, because that particular company also has a lot of company stock that is held by its employees. If you think about it, company stock is in some ways the worst retirement asset you could possibly have. It's perfectly correlated with the very worst outcomes for you as an individual. If your company suffers, you would suffer doubly, both in your own personal income and in your future retirement prospects. So for that plan, we would have a far lower equity allocation at the retirement date of only 40%. And obviously, all of these things are subject to change as the world evolves and participant behavior changes and regulation changes. All of these are good reasons, I think, to have some kind of customized target date scheme as a default. But even a very good customized structure isn't going to solve the problem of managing market risk, longevity risk, and inflation risk. And let me just briefly touch on how we think all of those can also be accommodated inside the target date idea. The volatility management idea is a very simple one, really. If you think of what a target date fund is trying to achieve, it's trying to move you through the life cycle from a riskier exposure when you're young. Think about the red line here is showing the risk that's expected as you move through the life cycle. When you're young, you should take more investment risk, roughly equity risk. And then as you move through the life cycle, you should bring your target volatility down until towards the end of the life cycle, your risk should be similar to bond-like risk. Well, the blue line on this chart shows the actual volatility that would have been experienced by someone scheduled to retire in 2010 and was in a target date fund that had that profile over the previous 40 years. What you see is, of course, that the blue line looks nothing like the red line. There are times when the actual risk that you experienced was much lower than what you expected, and there were times when the risk was far higher, including, of course, in 2008, 2009, 2010. And that's a big problem for target date funds. How can we help solve that? How can we sort of have a shock absorber that smooths the ride? Well, we think that there are a number of approaches, but what seems the most promising to us is to have a volatility management sleeve or component that's part of the target date structure itself, which is designed to try to pull in the tails of the distribution so that you're, essentially, if you think about the volatility as being roughly a bell-shaped curve, you want to move from the red curve on this chart towards the blue line, where you have less weight in either of the two tails, so less large losses, and the price of that is fewer large gains. The trick is to do this without significantly moving the entire distribution to the left. It's very easy to buy downside protection if you pay a lot. That's not the point. We think it's possible, though, to do much better. And I'd be happy to, if time allows, and the questions, to give you some insight into how we think we can do that. But if you just agree that it would be a nice thing to be able to do in principle, it's very easy to apply that inside a target date fund. The way you do it is you create a slice or a component of the allocation which is funded from your equity allocation that's in the volatility management asset class, think of it that way, and which in normal times is invested in equities. But when volatility becomes elevated, like it did in late 2008, that slice has the ability to de-risk out of equities and into safe assets like bonds. That allows you to tailor the overall level of risk in a portfolio far more effectively and more nimbly than I think you would agree is possible in most portfolios today. And the tools that we use are, we have tools that attempt to forecast risk and forecast return. And when risk is elevated, we will typically be taking the assets in the volatility management sleeve down as appropriate, because you're getting effectively more risk in your portfolio than you're typically being compensated for. So for example, in early January of 2009, our tools were saying that expected risk in portfolios from equities had become exceedingly elevated. The returns from equities we thought were higher than normal, but not nearly enough to compensate. So as you can see in the two bars on the right side of this page, the volatility management sleeve would have gone from its normal position of being fully in equities towards the right hand of the two bars, basically being out of equities. And that would have brought the risk level of a target date fund significantly lower, and thus helped smooth the ride. Now, market volatility is a problem, but it's not the only problem, or even really the biggest problem that retirees are likely to have. If you want to know what the biggest problem retirees are going to have is, it's probably inflation. And this is perhaps a harder argument to make in the US right now than it is here in Australia, because in the US people are, at the moment, still mostly worried about deflation. But it's very easy to demonstrate that over the last 100 years, virtually the only times when a traditional balanced portfolio has actually lost money in real terms have all been during inflationary episodes, like the inflation spike in World War I, the inflation spike in World War II, and the period in the 1970s, which was very damaging for portfolios both in the US and obviously here in Australia too. Amazingly, if you look at the Great Depression in the US or in other countries, depressions have not been, in real terms, huge destroyers of wealth. And it's hard for people to believe that, but we've run the numbers many times. The reason is that in big depressions, the price level actually drops fast enough that that even a 60-40 portfolio over periods as long as a decade will tend to retain its purchasing power. So how do you protect against inflation? And I think that the key message that I would want to leave you with is that inflation-linked bonds are, of course, part of the solution, or can be part of the solution. They have very good reliability and cost effectiveness as an inflation hedge, but they have one terrible problem. They aren't terribly inflation sensitive. If inflation kicks up fast, unless you have most of your portfolio in inflation-linked bonds, you won't have enough of an effect to make much of a difference. And all the other inflation hedges that have more inflation sensitivity, like gold, commodity futures, commodity stocks, and so on, have another problem, which is that they are very sensitive to inflation, but also quite unreliable. As a result, what we think is the best thing to do is to have a portfolio approach and to really buy a carefully calibrated mix of all of these different types of inflation hedges. And that, if you look at the last row on this chart, you'll see that's where you get the best combination of sensitivity and reliability from an inflation strategy. The other thing I would tell you on the inflation front is many people, especially in the US right now, are waiting to buy inflation protection on the theory that right now it's not needed. Right now the price movement is more disinflation, not inflationary, and that's true, but it's also, in our view, the wrong way to think about this. Inflation protection is always going to cost you something. You're going to have to pay a little bit of a risk premium to buy the protection. It's a form of insurance. But you have to buy that insurance when it's available at a reasonable price, which it currently is. If you wait until such a time as inflation has become manifest in the economy, at that point the cost of the inflation will be, the cost of the inflation protection will be much less affordable. And you can see in the last major inflation cycle, we put the data down here, that it was really very clear that asset markets anticipated the expected inflation change. If you waited until 1974, when expected inflation did spike up, you'd already missed a huge part of the run-up in asset prices. And we think the same thing will happen in the next inflation cycle. By the way, I don't particularly think it's going to happen anytime soon. It's not in the next year or two, in my view. But I do know this. If you wait until it's obvious that it's happening, you will have the same pattern that you saw in this chart. The time to buy inflation protection is when it's cheap, which it is now. And finally, the single most important thing for members in super funds or in USDC plans is a steady income stream in retirement. And by the way, it's also the most elusive and hard to deliver. Everything else I've been describing today, I should mention, we are currently managing for clients. The one thing we haven't yet been able to deliver is a fully satisfying income solution that is lifelong. But I have a high degree of confidence that we will finally be able to lick that problem within the next year. We think we are finally there. It took us a lot of research and a lot of hard work with insurance companies and other providers. And the reason that this is a hard problem is because, in our view, there is no product in the market today, at least in the US, and I'm pretty sure it's true in Australia, that meets the stated needs of DC plan participants or members. What members will tell you they want is very simple. They want to have a combination of certainty of lifetime income, but also control of the assets. Members do not want to buy annuities that basically mean that the insurance company has control of their money for the rest of their life. They also don't want to buy a cleverly designed and fairly complicated product that means that at age 85, if they live another 10 years, they'd be out of luck. They want something that's going to really be there for the rest of their life, where they will have access to the money if they need it, but where if they don't need to have access to the money, they can actually live off the proceeds with a high degree of confidence. And if they do, then if they have money left over, they can pass that on to their beneficiaries. It so happens that there is an insurance product that has many of these characteristics. It's called the Guaranteed Lifetime Withdrawal Benefit. Currently in the United States, it is packaged mostly in retail form. In that form, it's way too expensive, but we think that a super fund or a USDC plan is in a great position to fix the reasons why it's expensive. Because the high expenses of US and European guaranteed lifetime withdrawal benefits are related to the fact that they're currently sold individually, which is very expensive, and which also creates large adverse selection risk for insurers. In the context of a DC plan, especially if it's part of the default investment, all those problems can become attenuated because you can automatically include this kind of a guarantee inside the structure of your target date fund. Again, this only works if your default is a target date option, because you don't want to buy the insurance until someone's approaching retirement. It's not cost effective to buy a guaranteed lifetime withdrawal benefit for a 30-year-old, but it becomes very sensible to do it for a 50 or 55-year-old. And we think that the final point on this slide is also very interesting. To really make this powerful in the US anyway, we've designed it so it can be multi-insurer. The reason I think is evident, especially after the collapse of AIG. There's no insurance company in the world that can ever say that they will for sure be there in 30 or 40 years when the money is needed. And to make sure that they are, you have to have some way for both plan sponsors and participants to diversify that risk. And let me just highlight why we think this is a really compelling idea. So if you had, for example, a participant who was in a target date fund that was designed to be a 2010 maturity fund, their life experience would perhaps have looked like the dotted red lines on this chart. They show the account value that that participant would have experienced if they'd started investing at age 50 with a certain sum and contributed in a regular fashion to their portfolio year by year thereafter. The key thing you'll notice is that this participant got absolutely hammered in 2008. Their balance fell by something like 25 or 30%, which was actually the experience of many of the participants in US DC plans. But their experience would have felt so different, we think, if they'd had a guaranteed lifetime withdrawal benefit. What would have happened is their guaranteed income would have started at a low rate level, because you wouldn't have essentially bought the insurance for all of their portfolio when they were younger. And as they moved through their life cycle, you would have gotten more and more guaranteed each year. The structure of the guarantee is, by definition, it's a guarantee, so the income level can never go down. It can only go up, either because you're buying more guarantee or because markets are rising. And we think that if you did have this sort of approach, perhaps it would have to be tailored differently in the Australian context, it would focus attention on the right thing. It would focus attention on what the guaranteed benefit level was year by year as someone moved through their life cycle. This is exactly what participants tell us they want. They want something that they can use for life planning purposes and which simplifies their life. And I think the key point here is the underpinnings of this are extremely complex, but the outcome is really very simple. And in a way, it's making DC very much like a DB plan once again, but in a way that we think will prove to be far more sustainable than DB has proved to be. So our belief is this is going to be a major opportunity in the US for us. I would suggest that it might be the same here in Australia. And the beauty of this, for many of you in this room, is this, once it becomes ubiquitous, is what takes care of the rollover problem. If you think about it, when your members are about to retire, when they have the highest balance that they're ever going to have, is when they're also the most attractive targets for the self-managed segment, right? But if you're offering them a guaranteed lifetime income that they can only ever dream of getting at a reasonable cost if they're inside a super fund, how many people do you think would still be tempted to roll over in that case? I bet not so many. And I think you'd also feel pretty proud of the fact that you were offering them something that really was a valued benefit. We think this is where the industry is going to head. So let me just quickly summarize. We think that in the US anyway, the future is now pretty clear and may offer some lessons for Australia too. What US plans have chosen to do is default their members into target date funds. We think that increasingly, at the large end of the scale especially, those target date funds are customized to the needs of a particular plan and its particular membership. We increasingly see many plans trying to find solutions to managing investment risk, like using volatility management to smooth the ride. Increasingly, they're also thinking of ways to incorporate protection against tail risks like inflation, and we think that's a good idea too. And we think the next hurdle is to integrate a lifetime income guarantee that can really bring DC back to, in a way, the beginnings of the whole retirement idea. And I think, Otto von Bismarck would have really been pretty flummoxed by all of the things that have happened in the last 100 and some odd years since he passed away. But he could see that this too was actually a pretty darn good compromise, met an awful lot of objectives, and maybe from our perspective as an industry, if we can move ourselves in this direction quickly, we can also mitigate some of the risk that our governments will see the need to do it for us, which in my opinion will almost certainly be a less pleasant outcome.
Question at the front, please.
Seth, could you elaborate a little bit more on how you do the volatility management?
Yeah. So we believe that it is possible to forecast risk and correlation, both of which are different elements of risk. Volatility and correlation both essentially feed into the risk of any asset class. And obviously it's not easy, but it's also possible to some degree to forecast return for asset classes, all of which you can do with some margin of error. And what we've been able to do in the last few years is develop a set of integrated tools that give us signals of varying strength about each of those. And when we see very strong evidence that risk is elevated, we would, all things equal, want to hold less of whatever asset classes are especially risky. So let me just tell you where we are right now in the capital markets as we see it. We think that risk is currently above average in equities, not nearly as high as it was, say, a year and a half ago, but still elevated. However, what's also true right now is that return potential from risky assets is very elevated with respect to safe assets. That's partly because safe assets have returns that are so very, very low at the moment. And as a result, interestingly enough, we would recommend that a typical investor should probably be pretty close to their long-term strategic allocation right now, because they are being compensated enough to take the moderately extra risk that there is in risky assets like equities. But at the time of the Greek crisis, for example, in May, risk was higher than it is now, and returns were less attractive for risk assets, so we would have been materially underweighted equities at that point in time. We think having tools that give you that type of perspective and figuring out how to incorporate that in any type of default option make a lot of sense. And I do think, it's interesting that the Cooper Review implicitly opens that door. I think that's an excellent direction for super funds to consider going down.
Okay, and a question in the middle.
Hi, Wade Madison, Milliman. Seth, just interested, I guess, we've heard a bit earlier today where average account balances in the Australian superannuation industry are relatively low. When we start thinking about things like longevity, and people have, the bulk of their assets in the family home, where do things like reverse mortgages and the ability to access, other sources of assets at an individual level come into play?
Yeah, great question. So first of all, I think when people look at the average balances in super funds, they tend to look at literally the total super fund assets divided by the total number of accounts, which seriously understates what the average assets really are for a couple of reasons. First, because the average Australian has, I think at this point, between 2 and 3 accounts. So by definition, right there, you're underestimating by a factor of 50 plus percent how much is in their account overall. And secondly, the average Australian has only been in the super system for probably something like 12 years, I think is the 12 or 13 years, because you have a lot of new people entering the system every year. What you really should be worried about is how much people will have when they've lived through the super system and hit age 65. I think the estimates of that number are much less low than people think and are constantly going up. And obviously that will depend on whether the contribution rate goes from 9% to 12, and it'll depend on a lot of other things too. My guess is that ultimately what we'll see in this country is very similar to what we forecast for the United States, which is that balances today are far, far too low for anyone to seriously propose that they are a major component of a retirement plan. But in the next generation, the average person graduating from a lifelong super contribution will probably have something very substantial, probably in the order of at least $400,000 to $500,000 at retirement, and that's in today's dollars. So I think this problem will heal itself. And the issue that you're raising is a very real issue, but it's a transitional one. It's for the intermediate generation, which has suffered because DB has failed and has not yet bridged the gap to lifelong involvement with super. How will we solve their problem? And I think that, again, this is an opportunity for our industry, and it's one that we have to rise to meet. I do think that there will be ways of liberating assets from that are currently fairly illiquid and difficult to extract, like perhaps some kind of reverse mortgage system. I think that the problem with that product in the past has been that it's been very expensive, and often there's a huge information asymmetry, and providers perhaps have not given the best terms to the end users of that product in many markets. But down the road, if we as an industry are going to really be effective at solving the retirement problem for members, I think that's an excellent point. We have to figure out how this intermediate generation doesn't lose confidence in super, ironically, just at the point in time when it's poised to succeed for the next generation.
With that huge food for thought for how we design our future system, can I ask you to join with me in thanking Seth Masters and Alliance